Hey everybody. So I've had a few people ask me some questions about Chapter Three's homework. So I thought I would just try to take us on maybe a little walkthrough or tour of the homework. I'm not going to do it for you, which would be awesome. I know if I could just like do all the homework and show you exactly how it's done. But I'll take you on a walkthrough of it and explain some concepts that I think might help. As I've reviewed the homework, I do think the information is given to you in the textbook, that it's there, but it is pretty hard to dig out, especially if you have limited experience. So let me just walk through a few things real quick. So the way the homework's set up, I'm sure you've already looked at, is the questions are broken down into 8 sections. And so in the first section, on financial statements and reports, these are just kind of definitions, right? So it gives you a definition or description of which type of report, and then you can choose which one it is. And that's like, again, that's stuff that is like right there in the textbook. Um, so, the textbook is broken down by statements. It kind of gives you a brief overview of each one, which would be very helpful in completing that first section. And then there's like a full section on each of them. So I think that first section might be a little bit of work to dig it out of there, but there's even definitions here highlighted that will really help you with that. So that's that first page. So then when we get to the balance sheet, this is the stuff that I think would be a little bit challenging until you've had more experience with these. So if someone in here has taken accounting, this might be easier and less so if you've never taken accounting. So a couple basic premises that a balance sheet is based on. First is that our assets, that's stuff that the company owns. Okay, like it could be buildings and land, it could be cash, it could be money owed to us, which is called accounts receivable. The stuff we own, our assets, equals our liability plus our equity. And liabilities are debts that we owe to other people. And then equity is shows us what the owner's stake in the business is. So in other words, there's this two sides to the balance sheet: assets on one side, and then liabilities and equity on the other, and they have to equal each other. Okay. So for year one, 30,000 equals 30,000. So it's in millions actually. So 30,000 million, which is $30 billion. And then in year two, 37.5. So that's the first premise: assets equal liabilities plus equity. And then the second is that our assets will be broken into two groups: current assets and fixed assets. And so we know that our current assets, which are assets that are short-term in nature, meaning, or not short-term nature, but things that are cash or easily converted to cash within the next year. So our cash and cash equivalents, our accounts receivable, our inventories, those are all our current assets. So our total current assets plus our total fixed assets, which in this case there's only one, so it will be net. Plant and equipment is our only one fixed asset, but our total current assets plus our total fixed assets will equal our total assets. So for example, you can see like in year one here, we have total current assets of 13.5 and total plant and equipment of 16.5. Those add up to 30,000. So if we're like, how do I get this number? Well, we would say our total current assets plus this number equal 37,500. And so we could just do a simple subtraction and we could find out our net plant and equipment. And we know that all of our current assets, cash and cash equivalents, accounts receivable, and inventories will add up to the total current assets. So if we know the total current assets, if we just subtract out inventories and accounts receivable, we'll be able to find our cash and cash equivalents. So that's a little bit about a balance sheet that I think might be helpful in completing the work. Section 3 is the income statement. Again, a basic premise about an income statement that will help is that our sales minus our operating costs and depreciation and amortization expenses gives us what's called our operating income. And then our operating income minus interest expense gives us our EBT, or earnings before taxes. And then minus taxes gives us our earning after taxes. And then these tell you less preferred stock, etc. Tells us how much gets contributed to retained earnings. So just, I mean, this first line you can use as a, example of how one should be set up. Okay. And all this problem really is doing is telling us that we had an increase. Let's see. The CEO would like to increase sales by 25% next year. So to figure out our forecasted sales, we would just do 15 million plus 25% of 15 million. The easiest way to do that is just to do 15 million times 1.25 or 125%. Because that's really what we're saying, is that next year in year 2, our sales are projected to be 125% of what they are in year 1, 18,750,000. And then it tells us at this level of sales, our interest costs will increase from 10% to 15% of earnings. So again, we'll have to take our earnings, multiply them by 15%, etc. So that's the process we're going to use to figure this out. Recognize that the main relationship between these items is just that, and you can see it's even written out here. So sales less this, which means subtract that, gives us operating income, less that, etc. So hopefully that kind of helps you see how one of these is laid out. Section 4 is the statement of cash flows. And the statement of cash flows is pretty complicated. So they're not even going to have you deal with it too much. Instead, what they want you to recognize is the difference between different types of activities. So we have 3 types of activities in a business that impact our cash. The most common type is called an operating activity. Think about if you run a business, you're probably buying stuff and then selling it to people. So any costs, any cash that you spend to buy stuff or to operate the business, have the lights on or have insurance, all of those are operating activities. Sometimes we invest, meaning the business will buy major assets that will last a long time, things like buildings and land and equipment. So anytime we buy buildings, lands, and equipment, that's a cash flow that's related to investing. It could also be selling building, land, and equipment, those types of things. And then finally, financing activities is anytime we borrow money or raise money through selling off a portion of the business. It's called issuing stock in a corporation. So those are the 3 types of activities. Again, those are covered pretty well in the book, but just a little review of those. Stockholders' equity. I mentioned earlier that stockholders' equity is just the amount of the business that kind of belongs to the shareholders or the owners of the business. And remember, I told you that assets equal liabilities plus equity. And so this says, which of the following best describes shareholders' equity? Equity is the initial claim of value of the assets before the firm pays off its liabilities. Or equity is the difference between the company's assets and liabilities. And if we know assets equal liabilities plus equity, if we're good at algebra, or even basically good at algebra, we could figure out that that also means assets minus liabilities equals equity. So that's what that means. Really, it just means if you take everything the business owns and then you subtract from it all the debts the business has, what's left over is the amount that belongs to the owners of the business. And that's what equity is. Free cash flow is just again, so here's a definitional thing. You can look that up in the book. Again, we could go here. We could look at free cash flow. And it's going to give us a definition right there. So I think that's the sort of stuff that you can figure out. And I don't want to do too much here for you. The relationship between the book value of the shareholders' equity and the firm's market added value added or economic value added. So again, this is this idea that we have the book value of our shareholders' equity, which means really our assets minus our liabilities, but also know that in time, sometimes that doesn't really tell us value. It just tells us the difference between the cost of our assets and the amount that's owed to us. And so our value added is what the business is really worth, or another way of figuring out what the business is worth. And so there will often be some difference between the business's book value and between its market value added value. Okay, again, that's covered pretty well in section 3.8. And then the last one, the tax system. Again, it's just going to talk a little bit about the fact that business owners have to pay taxes, and give you a little bit about how we figure out and have to pay taxes. And so again, I think that this is again covered really well in the chapter. So I think that the biggest things that might be new to a lot of people and that weren't covered maybe as clearly as they could have been was the balance sheet, the income statement. And so I hope that was helpful. And I hope you are able to be successful in completing this work. And if not, please reach out and I will do my very best to help.